Good afternoon and welcome to this CLE on the fundamentals of the home buying process. My name is Petros. I am Vice President of Regulatory Affairs at the National Association of Federally Insured Credit Unions. I'm also Chair-elect of the Virginia Bar Association's Young Lawyers Division and the lead on the Wildy's Credit Issues Project. Today, I am proud to be joined by a distinguished panel of speakers to cover this critically important topic. The home buying process is certainly complicated, whether you are in the market for a home yourself or are advising clients on the process. So today we are joined by Jacqueline Jackson with Chartway Credit Union, Tiffani Norris with Village Bank Mortgage, and Bill West with TowneBank Mortgage. So please welcome our speakers, and we will jump into our program in just a moment. I did want to take an opportunity to encourage you all to share your questions with our panelists through the chat function. So please submit your questions. We will pause in between sections of today's program to answer those questions and are really excited to engage with you all. So with that, let's jump into our presentation. All right. Just some brief introductory information about our speakers. You all should have access to these slides as well, or we can provide them after today's presentation. So if you are interested in learning a little more about our speakers, you can access that information here. Our first topic is what to know before starting the mortgage process. And Jackie Jackson will be leading us through that conversation. Jackie, I'll pass it off to you.
Okay. Thanks, Ann. And thank you to the Virginia Bar Association. It's great to be here today. And let's just jump right into it. We're here to talk about what you need to know before you even start the mortgage process. And really, you need to think before that. I know you might be excited if you're a person who's on this call today because you're thinking about buying a home. You may think that, I've got my funds together and I'm ready to do a loan, fill out the application and everything, but we want to take a step back. There's a couple things that you need to do before you do an application. And on this slide, we're going to talk about 3 different things. Now, again, you may think I have my funds ready. I'm ready to do a down payment. Let's go. But with everything in life, you always got to think about what else might come along. So you need to think about reserves. Now, what are reserves? You may have your down payment, but think about all the things that will be involved with the application process. There are fees involved. There are closing costs. You need to have money set aside. Once you get the house, you're probably going to want some furniture in the house. Anything that you might not have thought of, appraisal costs, closing costs, all of that sort of thing. So you want to have a separate pot of money set aside for anything that's outside of your down payment. So again, you want to think about having money set aside for, I think incidentals or accidentals, if you think about it that way. So make sure you're thinking about what kind of money you have aside to pay for those. The second thing you want to think about is your employment history. And the reason why you want to think about your employment history is that you're building a story. When you're applying for a loan, you're telling the lender the story of you. So when you fill out the application, they're going to ask you questions about your employment history. So you're going to need to make sure you have all the information regarding all the different jobs you've had, at least over the last several years, because you want to show, when you're telling about the story of you, what your progression has been from job to job to job. Now, we understand that a couple of years ago, we had COVID, and unfortunately, a lot of persons lost their jobs or they went down to part-time. That's understandable. If you didn't lost your job back in 2020 during COVID, that doesn't stop you from the application process. Just explain what happened. Lenders know this. Everyone went through that. But if you have part-time jobs, you want to talk about that. if there's gaps in your employment, maybe you had to take care of a family member that was ill. Maybe you had to take care of children. Maybe you dropped out of, for whatever reason it is, and there's a gap. Just make sure you have an explanation for that. It doesn't stop you from getting a loan. You just want to make sure you have those answers ready should you be asked. Then the third thing you want to look at is your credit. Credit is the one thing that's going to be pulled. You want to make sure that, again, if you're building the picture of who you are, you want to make sure that your credit report, all three, reflects your credit history. So before you even get started about doing the application process, pull your credit reports. Make sure there's nothing on there that's inaccurate. If it is, get it taken care of, take it off, make sure, because at the end of the day, that credit report is going to be a big factor in what kind of loan you can get, and also the interest rate you're going to get. So if you want to go to the next slide. Okay. A couple of good things that have happened in the last year, though, when you're looking at your credit report. In 2022, there were changes that said that any medical bills that went to collection are no longer on your credit report. So remember what I said, the credit report is telling the story of you. So if you have medical debt that's showing on your credit reports, get it off in there. It's not supposed to be on there. So if you do see something on there, get in touch with whoever the collections company is, or the credit reports companies, and make sure it's taken off. Also, if you have any medical bills that went to collection and they're under $500, they should also not be on your credit report. So this is why it's important, before you even start the application process, make sure your credit is accurate and reflects who you are right now. Make sure you're checking your credit reports. Make sure that there's nothing on there for any medical bills that you have paid off. It should not be there. And anything that's under $500 that has went to collections, make sure it is not showing on your credit reports. Next slide. Okay. Now, from this slide, there's a lot of things on here. And one thing you want to do is, if you can, from those reserves you had before, if you can pay down your debt, do that. Again, you want to show the picture of who you are. When lenders are looking at your credit report, they want to see how much credit that you have outstanding right now. So if you pay something down, do that. Now, the one thing I want to say off of this slide is, if you consolidate loans, debts, and sometimes it's just better because it just gives you a better sense of mind. If you have fewer credit cards or whatever that's there, then go ahead and consolidate. But the one thing you don't want to do, you don't want to close those accounts. Keep those accounts open, because again, this is telling the story of you. If you've had a credit card for, say, 10 years and you paid it consistently over time, that looks good to a lender. That shows that you're good credit risk. You know how to take care of credit. There's less risk in lending to you. So you can consolidate, and you may have a credit card that's at a high rate and you don't want to use it anymore. Fine, consolidate that to something maybe more recent that has a better rate, but don't close that out, because you want your credit history to continue. You want it to be seen, okay? So again, there are about 26 million Americans that do not have any kind of traditional credit scores and that sort of thing. There's some things that are coming, and that alternative scoring is going to be available. They're going to be looking at rent payments. They're going to be looking at utilities. Again, you just want to make sure that when it comes to your credit score and how you pay debt, how you pay your bills, that everything is accurate. If you have, again, going back to credit cards, if you have a credit card or any kind of loan, whatever, that has been out there for at least 99 months, that's the best thing. So again, do not close anything out on accounts where it's been long-term. You want to keep those. Your payment history is 35% of your credit report. So you want to make sure that it shows you in the most favorable light. Next slide. Okay. A couple of things you want to do. Also, we're in the pre-phase now. You can get your credit reports, all three of them, at least free once a year. So if you go to www.annualcreditreport.com, on that one website, you can actually get a copy of each of your 3 credit reports. Go out there, they're free. Take a look at them. Again, make sure there's nothing on there that is inaccurate. Get that all taken care of before you apply for a mortgage loan. Second point I want to make off on this slide is that all of us get a lot of junk mail. We all get a lot of credit card offers or loan offers or whatever. First thing you want to do is actually opt out of getting all of that. First of all, you don't want to be tempted to do anything at this phase right now. And also, there's a lot of ID theft that's going on. There's a lot of persons that are stealing mail. Unfortunately, they're robbing U.S. Postal Service persons. And if there's credit offers in that mail and someone gets that and uses identity theft, now you have something on your credit report that you've got to get fixed before you apply for that loan. So right now, again, if you're getting a lot of junk mail for credit cards or whatever, do what you need to do to get that stopped. And if you go to optoutprescreen.com, you can just take care of that all at one time. Next slide. Okay. Now, I'm not going to spend a lot of time on this slide, but this kind of tells you about the different kind of loans. And this is, speaking from Chartway, this is the kind of loans that we have, that we offer. We do offer conventional loans, FHA, and I'm just going to spend a little bit of time on this because Bill is going to tell you a little bit more about this. ARMs, you've heard about adjustable rate mortgages. And you may see these kind of terms when you're looking at different kind of mortgages. So very briefly, when you're seeing these numbers, and I'm going to look at the first one, it says a 10/1 ARM. What does that mean? That means that if you get an adjustable rate mortgage, for the first 10 years of that mortgage, it's going to be at a fixed rate. And the number after that is the one means how many times it's going to adjust. So for the first one, for the first 10 years of your mortgage loan, it's going to be a fixed rate. And then after that first 10 years is done, every year, once every year, that loan is going to readjust. So that's what that means. And this is what Chartway has, but there's many different kinds of ARMs out there. So make sure you take a look at different ones. Look at what different lenders are offering. What fits your budget? What fits what you want to do? Another one I'm going to pull out here is it says 5/5. So using that same terminology I talked about before, that means for the first 5 years of your loan, it's going to be fixed. And then after that first 5 years goes by, every 5 years, that loan is going to readjust. So that's what that means. Another thing I want to put out on this slide is an I-10. It's one of the loans that Chartway offers. There's other lenders that also offer this loan. And it's usually for persons that are new to the country. Maybe they're resident aliens or non-resident aliens, and they cannot get a social security number, but they can get an individual tax ID number. So it's persons that are in the country that are not U.S. citizens. They're working here. And because they can't get a social security number, it may be a little bit difficult for them to get a loan. So using that I-10 number, you can apply for a loan. Now, the rates may be a little bit higher, and a down payment, a larger down payment may be expected, but wanting to get a home is not going to be stopped because you're not a resident of the United States or you don't have a social security number. There's different ways to get a mortgage loan. Okay, next slide. Okay. So we've talked about resources. We've talked about you got your down payment together. Make sure you think about everything that you have. So you may have money in your checking and your savings accounts. Also think about your CDs. If you have any investments, that all goes to your down payment. Your tax refund. I know we're in November, about to go in December. We will be thinking about taxes in January. So if you have a tax refund coming and you're thinking about doing a loan in spring, then also consider that as a down payment if you can. Okay. If you have a bonus coming because it's an end of year and you've done great over the last year, also use that as part of factor that in when you're doing your down payment though. Okay. Next slide. Okay. Now this chart I put in there for a reason. You may have heard, and there's a lot of talk now saying that this is a bad time to buy a house. That's a lot. There's a lot of, people are not selling or they're selling really high. I wanted to put this in there. I'm going to read a couple things because this is just a chart I just found. And you'll see that rates haven't reached this level in about 23 years. If you're looking back, the spike was back in the 80s. And we also had you look at the lowest is like down in 2020, which was right around when COVID hit. So over the decade between 2010 and 2020, rates didn't exceed 5%. And then COVID came along and you see what happened there. So prior to that, between 2001 and 2010, rates didn't exceed 7%. So granted, we are seeing an uptick in rates. They're not where they were back in 2000. They're very close, and they're definitely not where it is in 1980. The one thing to take from this slide is that when whatever goes up comes down. And you don't want to be in a position where when the rates start coming down, everyone comes out of the woodworks and now they want to start buying a home. You want to be able, if you can get the financing and it works for you, try to get it now because you can always refinance. What I'm saying is that don't want to wait. If you want to go ahead and get a home now, because this is what you want to do, and yes, the rates are high, they are going to eventually come back down. And again, you can refinance, but you don't want to be in a situation again where you're competing with a lot of persons for a loan. Okay, next slide. Okay, so now we're going to go on the home buyer's roadmap. The first part I was talking about was just the precursor to everything. This is actually going to walk you through the process, and there's 11 steps. We're going to take a little bit of time to go through so you understand what each step means. Okay. So the pre-approval. That means is that if you're approved for your loan, if you go in and you speak with a loan officer and they said that they give you a dollar amount of what your loan would be for, that offer is good for 120 days. They will pull your credit, you'll fill out the application, and then you'll start the process of actually looking for your home. What will you be asked for is that you'll be asked for at least your bank statements. They're going to want to look at your bank statements for the last 2 months. What kind of assets do you have? Any cash that you have, any investments, any direct deposits, or whatever you have. What are the assets you have? They're going to ask to prove your income. And how do you prove your income? Your W-2s. Again, we're getting close to the end of the year. January, you'll be getting your W-2s. Your 1099s that shows your interest on any investments that you have. Your tax returns that shows what your debts are, what your income is, and whatever you have, any refunds. They're going to see that as well. As for court documents, I have down there about alimony and child support. It works both ways. If you are receiving alimony or child support, that is income. And if you're paying it, then that is something that's coming against your income. So that's going to be something that the lender is going to want to see. The second step you want to have is now you want to get in touch with a realtor. And for all of the attorneys that are on this call, you know the term zealous advocacy. So that means you're doing everything you can for your client. Your realtor should be very similar to that, not to the point of zealous, but they should be working to do what's best for you. So what you need to do is be honest with your realtor. Tell them exactly what kind of home you want. Tell them what your budget is, and get to know them, feel comfortable with them. Talk with a couple different realtors. I know Bill and I know Tiffany and myself, we all work with all of our companies. We work with different realtors. Ask your friends, ask family members. If you have coworkers that have worked with a great realtor, reach out to them, because this is a big investment. This is a big step, buying a home. So you want someone who's going to work with you, who understands you, and is going to get you to the home that you want. You want someone who's going to be good at negotiating for you. If you see a home that you like and maybe the price is too high, you want someone who's going to work to try to get that down as much as they possibly can. I was at a meeting not too long ago, and I heard a realtor say, and this person's a realtor, said, a good realtor will help you find a home. A great realtor will find you the best home of your life, meaning that they're not going to take you around to see different, homes that are out of your budget. You'll see that on TV. You see it if you watch HGTV like I do. you'll see on some of the shows, they take people out to see wonderful homes and they're outside of their budget, and then they show them a home that's in their budget, and there's always a little bit of friction there. A great realtor understands what you need, but they're not going to try to take you somewhere so you're disappointed. There should be someone who is transparent and talks to you and calls you and reaches out to you. If you find yourself in a situation where you're calling a realtor to find out what's going on, that's not the person for you. They should be forthcoming and telling you what they know, what they've found. They should be an expert in this area. Whatever the area that you're in or whatever kind of house that you want, they should be an expert. Again, reach out, get some references, talk to folks, and find the one that's right for you. Next slide. Okay, so now here's the fun part. Now you start shopping for a home. This is the really fun part. But even with the fun part, there's some work that you have to do. So remember what your budget is. Remember, you know what your down payment is. You know what your reserves are. You should have an idea of how much you can afford to pay a month. So look at your budget. Look at what your utilities are. Those are going to continue wherever you go. Whatever expenses, food, all of that's going to be part of it. So figure out what you can afford to pay and what you need to set aside for your mortgage payment. Think about what kind of neighborhood you want to live in. Again, this is what you want. This is the continuing story of you. So find out what kind of neighborhood you want to be in. And is this a home that you want to be in for life? Is it for short term? Figure out where you want to be. Schools are a big thing also. The school districts. If you have children or you plan to have children, what kind of school district do you want to be in? So if you're buying a house now and you think about starting a family soon, this is something you need to think about now. What kind of school system do you want to be in? When I talk about budget, you think about, like I said, your incidentals and food and your mortgage payment. But don't forget about fees. If you're going to be in a condo, you might have HOA fees, condo fees, and those are separate from your mortgage payment. So when you're shopping for your home, if you see something that you like, always keep in mind what your budget is, what any fees could be, ask for those, find out upfront if there's condo fees or if they're HOA fees, find out what they are, and then factor all that in when you're thinking about buying your home. Okay. Now, the next part is making an offer. Let's just say you found a house that you like. Maybe there's not a lot of people that's bidding on the house, and I'll talk about that in a moment. And you want to give them earnest money. And so what is that? That's like a good faith payment to the owner of the home to say, I am interested in this house. I'm going to put my money where my mouth is. I'm going to put down a couple percentage of whatever the house price is to show you that I am really serious in buying this house. Now, if for some reason your loan does not go through or the home inspection doesn't go through, that money comes back to you. And that money doesn't actually go to the owner of the real estate. It's actually given to a third party, separate third party, independent, and they hold that in escrow for you. But the money is there, and again, it shows the owner that you're serious about buying that house. Negotiating counteroffer, this is where your realtor comes into play. If there's really a home that you want and the value is a little bit out of your budget, maybe your realtor can go in and get some concessions, or maybe they could come back with a better offer because you're showing that you really want that house. But you're talking to your realtor up front and you're telling that person exactly what you can and cannot do and what do you want. Okay, next slide. Okay. Home inspection, you'll see it's in parentheses, highly encouraged. And the reason why you may hear people say the home inspection isn't important, back when COVID hit and there was a lot of people that were buying homes, because I remember I was buying a home at the time, there was a lot of persons that were saying that, they were buying the house without an inspection, without appraisal, and it was because there was a lot of demand and there wasn't a lot of supply. But in every case, I would strongly recommend that you get a home inspection. Reason believing is you don't want to be in a situation where you think the house is one thing and it's valued at this, and you walk in and the HVAC is not working. Because now that's going to go against those reserves you set aside for other things, like maybe you want to buy furniture. You don't want to walk into a house and you have to fix everything up unless that's part of what you want to do. If you want to buy a fixer-upper, that's different. But if you want to walk in and like be able to actually live at the house that day, you can walk in, water's working, air conditioning is working, heat is working, everything, roof is not leaking, and everything is working, then you want to make sure you have an inspector that goes in and will look at that property and will come out and will give you a report of everything that's working right and anything that's working wrong. This is the time to ask the questions. If there is something wrong with the property, again, there's problem with electrical. Again, like I said, I watch a lot of HGTV. If you watch some of those shows, you will see people will go in and buy, and then they find out the foundation. There's a problem with the foundation, and that's more money. You want to know exactly what you're walking into. This is an investment. This is part of your life. This is part of your story. So you want to make sure whatever you do before you buy this home, you know exactly what you're walking into. So get the home inspection up front. Another thing is an appraisal. And like it says, an appraisal is not the same thing as a home inspection. The appraisal is looking at what is the value of that house. What is it going for? Again, if you go back to HGTV, you'll hear the word comps. You hear the word comps a lot. All that is comparisons. You want to know what is the true value of that house. Look at what the other houses that have been sold in that area. So you have an idea walking in before you even make an offer what your house that you want is actually worth. So look at that. If there's been any upgrades to the property, find out about that. But you want to know what is the value? What is the true value of the home you're going into? Next slide. Okay, property insurance. Property insurance, first of all, I'm not going to name any of the big three, but one is talking about your hands. One has a little cartoon gecko, and there are a couple other. One has a flow. What it is that this is a big investment. So you want to make sure that your investment is insured. So before you make an offer, go and talk to a couple different property insurance companies, find out what it is. That's a separate payment. That's a separate bill. That's not part of your mortgage. So you want to get quotes about how they will insure your property. If you can make payments over time, every month, make a payment up front, but you also want to make sure that your investment is protected. There's a lot of talk about bundling. If you're working with someone who is insuring your car, and you might want to reach out to them and find out if you can get a better rate if you add property insurance on. Now, it may be better for you to just call and find out what property insurance is first, and then compare to bundling to make sure if it's better for you to do it separately or bundle it. But whatever you do, contact a couple different carriers to find out if you can get the best quote for you. Again, this is an investment. This is somewhere you're going to live. You want to protect your investment and your home by getting your insurance. Okay. Step 8 is the underwriting process. And both Bill and I believe Tiffani are going to talk about this, so I'm not going to steal their thunder. But what the underwriters want from you, again, there's information, because again, you want to tell them the story of you. You want them, when they're looking at everything and looking at this loan application, that it best reflects you in the best light. So they're going to ask you for your assets. Again, what kind of assets you have? Cash, investments, other property. What do you have to protect this investment, your investment? Your income. You want to be able to show what is your income stream right now. What is your pay that you take home every 2 weeks, every week? What is your income? Are you getting income from 2 jobs, 1 job? Are you part-time? Are you getting alimony or paying alimony? That's all important. Your credit history. We talked about this a couple slides back. You want to make sure that your credit history accurately shows how you are with credit. Are you good with paying credit back? How long have you had credit? Again, I'm going to say this again. Do not close out any kind of credit cards or any loans or anything that you've had for a long time, because that shows how good you are with using credit and paying credit. So your credit history, make sure that's clean. Okay. All right, going on to step 9. So once it goes through the underwriting process, the underwriter will tell you that it is clear and they can close. We're going to assume that that's what's going to happen. So you're going to make sure that's done. They're going to write off and say that go ahead and do the loan. There's a compliance department that will make sure all of the disclosures and everything is there and is done and you've received them. And then at the end, you're going to get your closing disclosure. And that's going to show all the expenses, everything that's involved with that loan. Okay. And then at that point, you're going to do your final walkthrough. You go to the house with your realtor and make sure everything is exactly as it was when you first went through the first time. Check and make sure there has not been any damages. Again, electrical, everything is working as it should. Next slide. And then closing, this is where you celebrate, whatever adult beverage you have. You're going to go to the either attorney's office or wherever you're going to sign the documents. You want to make sure you read the loan documents, make sure it is exactly what it says that they are. You're going to sign them, make your down payment, get your keys, and go to your new home. And then the loan is funded, and then the final deeds and paperwork will be filed with the county recorder to show the transfer of title from the seller into your name. I'm going to pass it over to Bill now.
All righty. Thank you, Jackie. So good little segue. There are a lot of different type of loans. One of the first ones that people get asked about when they're first buying a house, the first-time home buyer loans. I'm not going to spend a whole lot of time going into each individual one, but I'll tell you that there are a lot of different types of first-time home buyer programs. Fannie Mae and Freddie Mac, that we'll talk about more later, are controlled by the U.S. Treasury Department through FHFA, and they are keenly in tune to promoting first-time home buyer programs and home ownership, the American Dream. We'll talk more about that in detail. So both Fannie and Freddie have first-time home buyer programs. FHA is not limited to first-time home buyers, but was largely engineered by HUD to promote first-time home buyers. They only required a 3.5% down payment back when conventional loans used to have as a minimum of a 5% down payment. USDA, FHLB, and there are a lot of different state and bond housing grants and organizations throughout that are available. So there's one common theme with all of these. So if we can flip over to the next slide. What you have to be aware with for first-time home buyer loans, grants, or products is they typically come with area median income limits called AMI. So if you look at Fannie Mae's Home Ready product, you'll see that they are only eligible for first-time home buyers who have 80% or less of the AMI. Freddie Mac has a similar one. These products are very favorably priced. They get a more favorable price than a traditional mortgage. They are geared to helping first-time home buyers. They come with discounted mortgage insurance. So there's a lot of pros to them, but I'm signaling this out or calling this one out as a good example of some of the details that you have to look at when evaluating a first-time home buyer. One, are you a first-time home buyer? Generally means that you haven't owned a house in the last 3 years. So if you were, say, previously married and on deed, but not on the note, and you have not been divorced or released from that deed for 3 years, stop, ask. There are a lot of pitfalls there. Are you a first-time home buyer? Are you not? Each different product has a different answer to that. Generally speaking, all of them do have income limits. They are not designed for the very well-to-do to capitalize on grants or handouts. So one of the best ways that you can go and check your income, my favorite website, www.go.ogle, check out Fannie Mae Lookup Tool, FNMA, Federal National Mortgage Association Lookup Tool. You type in the address, boom, it gives you the area median income. It will give you 120%, 100%, and 80%. Those are the 3 buckets that you will most often see with first-time home buyer products. So there's a lot of neat opportunities, a lot of grants, a lot of industry participation and push to promote home ownership. So there's a lot of opportunity out there. Just know it's not for everybody. It is definitely driven by income limits. And do we have any questions before we move on?
We do have a couple of questions, but we can either take them now or wait until the end of this section.
What's your read? Any quick, easy ones, or do you want to save them?
I do have a question for Jackie related to the opt-out prescreen.com advice. Does that prevent an applicant from applying for credit for a home purchase?
No, it won't. If you opt out, it won't. The only reason why I would suggest is that, again, because of the fact that there's a lot of identity theft and a lot of persons are finding out that there are credit cards or something that has been opened in their name and it's not them, that you just want to stop all that flood of credit card offers coming back to you. You can always reverse it after you get your mortgage. Again, right now, you want to have your credit report to be as clean as possible. You don't want to get to this point and someone runs a credit report for your mortgage and they see things on there, because that's taking time away that you've got to get that fixed. You want to get your home now.
Yeah, I think the question may be geared more towards a credit freeze versus the opt-out. So right. A credit freeze is something that you would do if you suspect somebody's hacking you, and it's a defense mechanism. You can go online with the bureaus and lock your credit and prevent people from pulling it and looking at it. So that is more if you are a victim of identity theft as a precautionary. The opt-out, to Jackie's point, is cutting down on spam callers. There's something that we can talk about later called trigger leads, which are absolutely obnoxious, but we'll sidebar that for later. Any others, Ann? Or should we pass?
Well, I think we can move on unless you had any other comments.
I'm going to pass the mic over to Tiffani to give you a little dive into some of the minutia we get into in today's mortgage world.
Thank you very much. So I'm going to talk a little bit about the differences in income calculations. And so I tell a lot of people that I work with that it's very important when you are trying to determine if you qualify for a loan that you speak with a mortgage loan officer. And that is because there are differences in the types of income and the ways that we look at them, or the ways that underwriters look at them. One that's most important is that we look at your gross income, not your net income. So, and of course, you typically are going to be filling out the application by yourself. So I think it's important to know how to enter your income. So your actual income is going to be what's shown on your pay stubs, your W-2s, your tax returns. Let's say that you have a job and have had a job for several years, and 6 months ago you started working a second job. So you're bringing in income from 2 different jobs. That's your actual income. However, what's very important for the mortgage underwriting process is what is your qualifying income? And that is only the income that's going to meet the loan guideline criteria. And the different types of loans have different guidelines with regards to how to consider qualifying income. So this is one of the first things I go over with people is saying your income is your income. Yes. But what we're really trying to hone in on is what is your qualifying income, because that's going to be used to calculate your debt to income ratio. So that is the most important. And then of course, household income really comes into play when we're talking about some of those first-time homebuyer products, and also going to be important if you are looking for grants. Anyone who's looking for grant opportunities, as Bill mentioned, those are supposed to be for low income earners, is to help them be able to purchase a home when they otherwise would not be able to. So they are going to consider all of the income. One important thing to know is that when it comes to more than one borrower applying on a loan together, you must use the credit from both borrowers, but you do not always have to use the income of both borrowers. So I like to point that out because a lot of people will have conversation with me about, okay, well, I have this income coming in from my fiance, but he's got really bad credit. And so I don't think he'll be able to qualify. Well, in that particular instance, we're not going to be able to use the income for qualifying income, even though it is considered household income. So just pointing out those differences there. So a few things to talk about with regards to that. Your salary income is always the easiest to calculate. And I will tell you the self-employment income is typically considered the hardest to calculate. But the thing that's very important to know when it comes to self-employment income and how they're going to factor what your qualifying income is going to be is based on what's going to be showing on your tax returns. So that's very important to know. If you are self-employed, you want to make sure that your income is showing on your tax returns, because if not, then typically underwriting guidelines are going to say that means you don't actually have qualifying income, and that may, hold you back from being able to qualify for a loan. When it comes to your primary job and salary, that is the easiest. When it comes to overtime or bonus income that you have in addition to salary or hourly income, some loan programs require that you have 2 years of that income and that it be steady or trending up year over year before it would be considered stable income to qualify for a loan. So again, important to know. Same thing is true with regards to commission and 1099 income that you may be getting. Also, when it comes to, say you have a second job, the thing to keep in mind is that they are also looking for you to have 2 years worth of earnings from that second job in addition to your main job for you to be able to use both in qualifying for the loan. So there have been times before where someone has started a second job in order to help them be able to qualify for a loan. And 6 months into that second job, they want to qualify and they will find out that they cannot use that money to qualify income-wise. But when it's calculated in their household income, it could hold them back from being able to get a grant. So if you're interested in purchasing a home and you want to know what your income calculations are going to look like for your qualifying income, I would urge you to talk with a mortgage loan officer sooner rather than later, and let them walk through those steps. Additionally, when you make application and they ask for those documents, like Jackie mentioned earlier in the presentation, make sure you give the documents they're asking for, because the worst thing is to think you know what the income is on the application, get under contract on a home, and then have the underwriter tell you that your qualifying income is completely different and you may not be able to continue to move forward. So just keep those things in mind.
Question for you, Tiffani, on income,
Yes.
specifically handling issues with debt to income, and whether there are ways to use what's called house hacking or renting rooms to offset that income. So
a lot of times when it comes to those types of things, considered border income, if you've got someone who's living in the house with you, say there's requirements for that. So typically they have to have been a part of the household for at least 12 months. They have to show you that they've been paying you rent. So they're going to have to track that. And so there's a lot of guidelines that go along with that. And there are some loan programs that will allow you to use border income while others will not. And so I, again, would definitely urge you, if that's something that you are thinking will need to be considered, talk to a loan officer sooner rather than later, and let them tell you what your debt to income ratio is. So they will do that based off of the income documentation you give them and looking at the program that you're going to want to qualify for and what the qualifying income is for that. So hopefully that helps answer the question. If there's a lot of things, I'll forewarn you when it comes to looking at these things, it's really best to talk to someone about your individual needs rather than just read information online, because that information may not pertain to you for one reason or another. So you want to have those one-on-one conversations with a licensed mortgage loan professional.
Great. Well, before we move on to the details of the regulatory framework for mortgage lending, Jackie, I have a question for you. Can I complete an application with multiple different lenders? And if I do that, is that going to affect my credit score?
You can, and I would actually recommend that you, again, shop around, find out which lender can give you the best rate and the best mortgage. It won't work against you. I would say if you're going to do that, try to keep it all within a short time frame, because if you, let's just say today you take out an application with one person, with one lender, and another within the next couple of days, when they pull your credit report, they know what you're doing. They understand that you're trying, you're shopping around, you're trying to get the best rate. So it doesn't work against you on your credit score. It's understandable. If you were to say, I would say, do an application today and then 2 months down the line, do a whole bunch more, that will look kind of different. That might affect your score. So I would highly recommend that you do at least reach out and see what's out there. I wouldn't say do a whole lot. Try to bring it down. Do some research, find out who you want to take out a mortgage loan with. Definitely go with at least more than one or two, because you want to see what's out there, what's best for you. But no, it won't work against your credit score because the lenders know what you're doing right now.
That's helpful. All right, and you will be leading our conversation, Jackie, on the mortgage regulatory framework here. But quick reminder to please submit your questions for our panelists. We love answering all of those questions, so keep them coming. And just to highlight, this is going to get into some of the weeds of the regulatory structure surrounding mortgage lending, but it is intended as an overview. So we won't be spending a ton of time on each particular item. We're a little more than halfway through today's program. But if you have questions around any particular topic, please send those in. All right, Jackie, off to you. Oh, excuse me, Bill is first.
All righty. So shameless plug for one of my absolute favorite books. If you haven't read Michael Lewis, he's the same author of Liar's Poker and The Blind Side. Highly recommend it. If you must see the movie, but please read the book. Does a better job. He does a great job of taking what was a very complex situation and breaking it down into layman's terms so that we can all get our heads around it. So one of the things that you've probably gleaned from the tip of Jackie's comments and Tiffany's detail on income calculations is the mortgage world is a very bureaucratic process right now. The government's been here to help. So without getting on a soapbox or getting too political on it, I'll try to keep it very, very neutral here and try and give you a little bit of a background as to how we got here. I will raise my hand and say that I've been doing this for 31 years. So I had a front row seat to the mortgage market meltdown and some of the chaos and how it happened. So interesting thread to keep in the back of your back of your head, thread pattern, thought pattern while we're going through this. Recognize that the United States is one of the only industrialized nations that enjoys a 30-year fixed rate mortgage. Other countries don't have this. You don't get a 30-year fixed rate term in Europe or other nations. The United States, up until recently, had a housing policy. We have the American dream. So we are out to promote home ownership. So interesting thing with this, the carnage probably started, if you look back in time, with a subtle shift in momentum. It was very well intended. In 1997, William Jefferson Clinton chided Fannie Mae and Freddie Mac to expand home ownership. They didn't have first-time homebuyer programs. They were fairly staunch in thinking that 5% down was the minimum that you needed. And for all the right reasons, for investing in communities, building wealth for consumers, and getting the economy going, Clinton said, hey, get going and move the needle. Funny thing is momentum has a way of building on itself. In 97, we were just about to get into credit scoring models. We were starting to look at the advent of automated underwriting processes, and momentum built and momentum built. And we got to just sort of a fevered pitch. And I will tell you that along about 2005, the market was enjoying such a roll that we were all reaping profits and doing exceedingly well. And something happened, something shifted. It went from a healthy market from when we were looking at the four C's: collateral, capacity, and character, and credit, the way we always had. So we got the advent of some of these funny loans. With 20% down, you can get a stated income loan. Well, the stated income had to match with your profession, and there were some safety guards around that, and you had to have a high credit score. Well, then it started to soften, and we could do it with 10%, we'll do stated income, stated asset. And it just got a little weirder, and a little faster, and a little faster. And the pivotal point where we all should have picked our heads up, and few of us did, unfortunately, was when they invented something called a credit default swap. A credit default swap is a way to bet against a bond. You could short a bond. You could always short a stock. You could win if you bet against a company and you were right and their stock price went down and you shorted the stock. The difference was your profit. There's no way to short a bond. Well, with a credit default swap and all of a sudden being able to bet against a bond, remember that a mortgage is essentially a bond. Mortgage-backed securities are bonds. They trade on the Chicago Board of Trade. They're considered commodities, not stocks. So when you could bet against a bond, what was happening? There were people that realized the market had come too far too fast. These creative mortgages had gotten out over their skis and taken on a weight and a momentum and a speed of their own. And so it was actually really, really criminal. Go back and read the book. But there were people who were creating mortgage bonds that were worse and worse and worse and more egregious and more poorly underwritten, not because they were trying to write more loans, but because they wanted to see the market implode. They really wanted it to go up in smoke. Why? Because they had this huge bet against bonds. They had credit default swaps. They were betting against the mortgage market, and they didn't win that bet and reap those profits until the whole thing imploded. So, yes, we are in a very bureaucratic world today. The consumer bears the cost of that compliance. Now it's about $8,000 a file. And Fannie and Freddie are still in receivership through FHFA. They've paid, I think, of the $191 billion bailout, they've paid a little over $300 billion back. I don't think the Treasury Department's giving them back because right now the federal government is squarely in control of Fannie and Freddie, and the United States still has a vested interest in promoting the sanctity of a 30-year fixed rate mortgage. And that's not going to go away. So I'll stay out of the politics of it, but I'll tell you some good things that came from Dodd-Frank. By the way, was not written by Messrs. Dodd nor Frank. This is the spawn of Elizabeth Warren. It just would have been dead on arrival politically. It had her name on it. So it was really written by her pages who were between 20 and 24 years old and had never even borrowed money to buy a car. So some of the strange things that we get into as lenders and having to explain to borrowers, hey, this doesn't make sense, but I'm going to ask you for this, and it has nothing to do with your ability nor willingness to repay the loan, but I got to check this box. Otherwise, you don't get a QM mortgage. So some of the inane things that we have to explain to our customers are painful, but at the end of the day, there's some really good news. We still enjoy a 30-year fixed rate mortgage. It is still backed and promoted by the United States government. And I will tell you that the loans that are written today are written at a really, really high level and highly scrutinized. They are not subject to defaults from bad underwriting. They are predicated upon really strong collateral. They are not going to go under, barring some huge loss of jobs and huge economic turmoil. It's exceedingly well written, and the bad actors are largely out of the market. We as lenders now have individual skin in the game. We have personal licensing numbers. So the bad actors are out of the weeds, and we're in a much stronger position today. It's got some headaches with it, I won't lie. There's some bad to it, but overall, we were in such a bad position after some of these bad actors intentionally blew up the market. Congress had to act. They didn't have a choice, and this is what we have. So with that, I think we're going to pass it over to Jackie to get into some of the details of exactly what we live in terms of a regulatory world today.
We have a quick question from the chat.
Okay.
How much should be planned to set aside for incidentals? Is there a recommended max percentage of income to devote to a mortgage payment?
So generally speaking, financial planners will recommend not to spend more than a third of your gross monthly income 33%, and that will vary from person to person. Sometimes higher income earners have more disposable income to devote towards a housing expense, but think a third of a gross monthly income is a really good benchmark. And in terms of reserves, I also would tailor that advice to the client. What kind of job stability do they have? Are they 100% commission where their income goes up and down and up and down? That person probably wants, 6 to 12 months reserves of a housing expense set aside in some kind of liquid asset. Are they a young professional on a W-2 job with an upward trajectory and their income's going up and is very stable and not likely to have an upset in their professional career? They can probably get by being a little more aggressive with 2 to 3 months worth of reserves. So that one I would say really depends.
Awesome. And
sorry for the non-answer there. Did I cover that one?
No, that's great. And we have just about 30 minutes left.
All righty.
Okay, so I'm going to take over for right now. And I promise you, I'm not going to read through all these slides. For those of you who love reading regs, and actually I'm one of those persons, and I actually had to, in this role I had to. Some of these may look familiar to you, but the reason why I wanted to put them here is that Bill just told you the whole story of how we got to Dodd-Frank. So I don't want to let it be known that, and neither does he, that there wasn't rules on the books. It was just ways people were able to game the system. So some of these are going to be familiar. You want to go to the next slide? Actually, the rules about protecting mortgage borrowers have been on the books for at least over 50 years. So we're going to talk about truth in lending. That went on the books in 1968. And the reason why that went into effect in 68 is at that point in time, there was no standards. You could go to any person who said that they were a mortgage lender and none of the documents would be the same. There was predatory lending. Anyone could do anything. It was confusing language. And there was ridiculous late fees. So the government stepped in and said, we need to do something about this. So they put truth in lending on the books, saying that it had to be standard language. It couldn't be confusing. And they were trying to get their arms around trying to get predatory lending under control. Okay, so you're going to the next slide. Regulation Z, which came in 1970, actually implemented TILA. Again, it was to make sure that if you were taking out a credit card or any kind of credit, that you knew what the cost of that loan was. So you need to know what the rates are. It had to be straightforward. It couldn't be misleading. And everything had to be in writing. So no one could verbally tell you what it was. It actually had to be in writing. And the one thing I'm going to pull off from this slide is that it had to use clear language. Like I said before, in the past, they could use any kind of terminology and language they wanted. People were confused. Now you had to be very clear about what the loan was about. And if there were any complaints to that loan, they had to be responded to. Next slide. Okay, I think everybody knows what Equal Credit Opportunity Act is. It goes into discrimination. It prohibits any kind of discrimination to any loan applicant based on race, sex, creed, and very other things too. But what it did is it made it an offense, and there are penalties to that. Today, for all of it, for every mortgage loan company, the examiners will come in, the regulators will come in and look at your loans. And when they examine it, they're looking for this. They're going to be looking for, are there any practices where it could be seen that there's discrimination against a group of people? So ECOLA went on the books in 1974. It is still in effect today. Like I said, we got to Dodd-Frank because these rules were put in place in the past. Okay, next slide. Reg B, it means that a lender is responsible if they're found that they have discriminated against a borrower before the application process, during the application process, or after. So it's not just during the application process itself. So again, there are certain things you cannot discriminate against. It is very active. The regulators are out there. They will look at it. There are penalties to this. For any mortgage loan lender that is found guilty of this, the penalties are high. And it does go to reputation risk because it is printed in the newspapers. You see it all the time, where every now and then you'll see where a group has been discriminated against. I was reading today where one, I can't remember off the top of the head, and I'm not going to say exactly who it is, but there was a financial institution that was found to be guilty of discriminating against Armenian Americans. So that's in the news. That goes against the reputation of the lender. So it is very serious, and it's there. Okay. This one, it just says that, I remember I talked about escrow accounts. Money that is used to show good faith that you're really involved, that you really want this real estate. So that money doesn't go to the seller. It's a third-party entity that holds that money in escrow. And it's not paid out until certain things happen during the process of that loan. Next slide. Okay. This is where Dodd-Frank actually came into effect. And Bill, I will say that I remember this day. I remember it was January of 2013 when all of the mortgage lending regulations came down. Thousands and thousands of I think it was over a week's time. It was just thousands of pages of regulation, and it all came from Dodd-Frank. And I remember it to this day. I remember, like I said, January 2013, because I was working at another credit union. We had to know exactly what this meant. And it was, the way it was written is that it took you a long time to figure it out. And Bill, I will tag you and say it was like persons who had never worked in a financial institution before. But we had to figure out what it is. I'm not going to go through all this slide. I'm just going to say that one of the problems that they said is that there were persons that were getting loans before Dodd-Frank, where you could walk into any institution or anybody. There were people that were just quitting their jobs and becoming mortgage loan officers. And you could get a loan for a home that was way out of your price range, and you didn't put any money down. So there were a lot of rules that went into place. It said that now, as a lender, you have to make sure that the person who is borrowing the money can pay it back. Do they have the ability to repay that loan? That's in there. So there's a lot of information, and Tiffany has talked about, and Bill has talked about the information that has to be provided up front. There's a lot of calculation. It's very serious. You have to make sure that they can pay back their loan. If you put them into a loan that they cannot pay back, yes, that does hurt the individual because they can lose their home, but the regulators are going to come after the lender. They do look at those loans. They do the calculations. They may question it. So it's very important that when a lender makes a loan, that they calculate that that person can pay that loan back. Next slide. Okay. Qualified mortgages. Again, you'll see ATR and you'll see qualified again. Again, I'm not going to read from the slide, but what it means is that, that if you're making a loan, if you're a mortgage loan officer, or you're going in and they're making a loan to you, they're going to assume that you have to assume that that loan that's being made to you is you're going to have the ability to repay it back. So there are certain things that cannot be on that loan. I'm going to pull out one thing is negative amortization, which means you cannot be paying interest on it and the principal never goes down. You're just paying interest. It's got to be that, when you're paying against it, that loan is coming down. You got to have the ability to pay that back. Okay. So they can't be making risky loans to you. Before Dodd-Frank, anybody could get a loan, whether you had the money or not, or you had a down payment. Now, there's certain regulations in place that says you have to be able to pay that back. Next slide. Again, I'm going to leave this to the attorneys on the call to read. But also, if you're buying a home, pull this slide out. If you're in a situation where you're working, and I'm going to say this, you need to work with someone who is reputable. Make sure you know who you're working with when you're doing a loan. You should not be going to someone who just has a shingle out and says they're a mortgage loan officer. Everyone on this call knows exactly what they're doing, so you can feel free to reach out to anyone on this call. But if someone is trying to sell you an interest only loan, or they're talking about negative amortization or anything like that, if it's a loan that and they're not asking for a down payment, There are other exemptions to that, but they're saying, oh, you can have this $500,000 house for zero down, and you know that's in your budget. All I'm going to say is run away. There's something wrong. Remember, these rules are in place for a reason. It's got to be a qualified. It's got to be something that you can pay back. And again, I'm going to say, please read this slide. There's a lot of information in here. I can't pull it all out, but it's very important that you understand what a qualified mortgage loan is and what you should not be, should be said to you. Next slide. Okay, TRID. I remember this only because when this came out, they picked up this forever. They kept changing it over and over and over. And all I kept thinking about, this is like, TRID is like a scab that they keep picking. But the version of the document that we have now has been in place, I think, for at least 4 or 5 years. What it is that it actually took a couple former forms and they put them together, because you know the government always wants to make it easier for us. So they're going to combine some documents together. The good thing is that what they did is everything is in the same standard format. So if you're one of those person who wants to go to a couple of different mortgage loan, officers or companies, and you want to see what the best rate is, when you walk out the door, the loan estimate that you get should be in the same format. The information may be different, the numbers may be different because they're going to give you what their rates are, but the format of it should be the same. That way you can compare between the different offers that you have. The closing document is the exact same thing. It should be the standard thing, and you get it 3 days before you close your loan. You want to know what the expenses or what the cost of that loan is. And let me step back for a second for the loan estimate. You should get it 3 days after you actually file your completed application. So you know what's on there, you know what the cost. You can ask questions during the application process. The closing disclosure is 3 days before you sign the closing. Again, you want to make sure that everything that was said to you is exactly in that paper so you know what the cost of that loan is. If there's any discrepancies, now's the time to ask before you sign. Next slide. Okay, I think I jumped ahead a little bit. So again, you must got to get it 3 days before you loan app, and then your closing has to be 3 days before you sign. That last bullet point is important. If you actually apply for a loan, like I said, the examiners will come in, they'll want to see these documents. You have to keep copies of it. Any lender has to keep copies of any closing documentation, disclosure, and any loan estimates for at least 3 years after the signing. Examiners, the regulators will come in and make sure it's there. The next 2 slides are just examples of what the standard form looks like. So when you go in and you do an application, this is what the loan estimate is going to look like. Like I said, you can go to different lenders and find out what is best for you, but it should, the example of here, the format should be the same. The numbers will be different, but the format should look exactly close to the same. Same thing with your closing disclosure. You get it 3 days before the signing. It should look like this. If there's anything that looks different from this, question why. If you're working with a reputable lender, there should not be a problem, but this is what you're going to see. Next slide.
Okay, so I think I'm taking over at this point, Jackie. Okay, so now that we've talked a little bit about regulation, we're going to talk a little bit about the underwriting process. So we consider the 4 C's, right? So just like you consider the 3 C's for when you're picking out a diamond. So we're looking at capacity, credit, capital, and collateral. So these are the things that the underwriter is going to consider. So first, income, that is your capacity to repay. And they're going to look at your earnings, your employment history, the expenses that you have, the number of dependents that you have, and any obligations that you have. Like Jackie mentioned earlier, child support and alimony, if you're receiving it, could be considered as income. But if you are having to pay it, then it definitely needs to be considered as an expense when you're calculating up your debt to income ratio. So they're going to consider car payments, student loans, credit cards, personal loans, and any other debt, especially like if it's federal tax debt, that's all going to have to be considered. Now, capital that's the history of how much capital is considering a lender's ability to be able to, applicants' availability to be able to pay back the money. So they're going to look at your money that you have, your savings, your investments. They can also consider gifts from family members that could go towards your down payment or your closing cost. There are also down payment and closing cost assistance programs. Some of those, like the Federal Home Loan Bank, offer different grants, forgivable grants as they would call, but then there are other companies like Virginia Housing that just have actual home buyer grants. So no strings attached. Your first time home buyer, you get Virginia Housing loans, and you may be able to get that grant to help with closing cost and or down payment. There's also a thing called sweat equity, not used quite as much, but that is something to consider. So having money in savings and investments that you can easily transfer over to cash, that's what's known as cash reserves. And that proves that you can manage your finances and have funds in addition to the income that's needed to pay your mortgage. So again, that could be savings, money market funds, IRAs, CDs, bonds, and even 401k accounts that you have. So the other thing you want to keep in mind is large deposits that are coming in that you want to consider as a part of your assets. You do need to be keeping in mind that those large deposits may have to be sourced to make sure that they are coming from an acceptable source. There's very big limitations on borrowing money that you're using for purchasing a property. So one of the big things to also consider is the property or the collateral. So this is because your property that you're purchasing is going to be held as collateral for securing the mortgage. And if you can't pay the mortgage, then they may have the right to come and take possession of the property through a foreclosure process. I'm sure you all are familiar with that terminology. So they want to make sure that the collateral is sound. So they will do an appraisal report, and the appraisal report is going to have two different things that they're looking for. One, they want to make sure that based on a comparison of similar properties that have sold in that neighborhood, how does this property compare to it? They will come up with what the value is. They are also tasked with making sure that that property meets HUD's guidelines with regards to the condition of the home. So that there's always going to be the two things that are going to be taken care of. And again, the appraisal is different than a home inspection. So it's not going to go into as much detail. But if you have a sign of water damage inside of that home when the appraiser goes in there to do the appraisal, that could be a big no-no, and they may note that that needs to be corrected before the loan can be given. So that's just to kind of give you a little bit of an idea of the different things that are being looked at as far as qualification is concerned. I tell people that you want to have some strength in each of those areas, but if you have a weakness in one area, and you are stronger in some of the other areas of those 4 C's, that could help you as far as loan qualification is concerned. There also are some do's and don'ts. A good mortgage loan officer will provide you with these do's and don'ts when you get pre-approved. And that's just to make sure that you don't do anything once you're pre-approved that could possibly mess you up and present a hurdle from down the road. So these are important. Again, making sure that you're careful about what money is going into your accounts. That's a very big one, because if you have a deposit and it's a large enough deposit that the underwriter questions it, and remember, they have a right to question any and all of it. But if they see something and you don't have a way to be able to source it, or it's not from a proper and qualified source, that could present a problem down the road. So some of these dues were covered in what Jackie had to say earlier, as far as your credit is concerned. And I will also point out to make sure once you've applied that you keep your current job. Don't go changing your job without making sure that your loan officer knows. I think we can go to the next slide. And then we talked a little bit about gift funds. I try to make sure that people understand if you're buying a principal residence or a second home, you can use gift funds for down payment or for closing costs, or a combination of the two. However, you cannot use those to purchase an investment property, and you do need to be very mindful that there are requirements around this. So I tell my borrowers when I'm talking to them, if you know that someone wants to give you a gift for funds to help you with purchasing your home, you need to talk with them about the fact that your loan will require certain documentation, and make sure that they are okay with providing the documentation, because they may have to give bank statements to the mortgage company. Some donors are very timid about doing that. So you want to make sure that you're having a very open conversation with your loan officer from the very beginning about the fact that you're expecting to use gift funds, and ask them how to go about making sure that you can source that stuff properly. If you go to the next page, it's going to let you know, of course, that for different types of loans, the type of donor is going to be slightly different. It's a little bit more forgiving with FHA loans as to who can contribute gift funds as opposed to conventional funds. So again, make sure you have these conversations. And then the next page is going to give you a sample of what a gift letter looks like. Your mortgage loan officer should be able to provide this to you at the time that you are doing loan application. So I urge you to make sure you use the documentation provided by your loan officer, because if you don't, it may not be acceptable. The big thing is they got to make sure that they have some of this language that you'll see on the gift letter. And then, of course, I've also given you a little chart of required documentation, depending on how you are going to be receiving the gift funds. So hopefully this will just be a good reference material for you later. But again, always have that conversation and be transparent with your loan officer. And now I think I'm giving that over to Bill.
All righty. So real quick, mortgage-backed securities in the past have always traded in increments of 1/8. So you will see interest rates that will say 6 1/8, 6 1/4, 6 3/8, 6 1/2, 6 5/8, 3/4, 7/8, etc. Discount points, which we'll cover here in a moment, also trade in eighths. And mortgage locks are generally good for either 30 or 60 days. So real quick trivia question. Anybody know why we trade in eighths and settle in 30 and 60-day pools? Anybody? Okay, you put Bill on the geek box. Here we go. Goes back to colonial times. Again, mortgage-backed securities are considered a commodity. They trade on the Chicago Board of Trade primarily. So like any other commodity, it goes back to colonial trading times. Mortgage-backed securities actually trade in something called ticks, or 30 seconds. 1/32 is called a tick. What's a half of a half? Quarter. What's a half of a quarter? An eighth. Half of an eighth is a 16th. Half of a 16th is a 32nd. In colonial times, they could actually trade in their heads out into 30 seconds. I was never that good when I was on the trading desk. I could go into 16ths in my head. Technology has made us a little lazy these days. So anyway, there's your useless trivia for the day. Mortgage-backed securities trade in eighths. So you'll see interest rates expressed predominantly in eighths, and you will hear about things called points. Points, or one discount point, is 1% of the loan amount. A point goes to discount the interest rate, meaning you can buy down your interest rate. For the example on the screen, if you look at the middle column, if Wall Street is expecting 7.25% rate of return for the risk of lending money for 30 years secured by residential real estate, that's called a par rate. Par is a numerical expression for zero. Means that they're not charging anything, not paying anything. 7.25 is considered even money. Well, if you and I don't like the payments at 7.25%, and we vastly prefer the payment at 7%, obviously it's lower. In this example, it's $53 lower. It's $2,097 versus $2,150. I want to say $53 a month. The mortgage-backed security dealers are not the nice guys. They do this as a profession and as a business. They are more closely akin to Yovini, the loan shark, and they're going to say, "Hey, you cheated me 0.25% per annum for the next 30 years on my expected rate of return. You owe me something up front." You can discount the rate. You can buy down the rate. You can spend 1 point. Traditionally, 1 point was always equal to about a 1/4 point spread. So in this old-time example, you've got what was the median sales price last month? It was $394 and change. So I just rounded down and called it $394 for the average median price, 20% down. 7% is $2,097. 7.25 par money is at $2,150. And as we said, that's about $53 difference. So is this a good deal for a consumer to pay a point and save $53 a month? Well, in the old days, we'd pull out our calculator and we'd say, hey, the cost is 1 point, or that 3,152 divided by 53. I'm going to tell my consumer that it takes 59 months to recoup the cost. That's 60 months is 5 years. So say 5 years is a break even. Probably not a good deal. What is the opportunity cost of that 3,152? Could they spend it better elsewhere? Unless the seller is paying concessions that they get to utilize to pay their closing costs and maybe a point and write off on their taxes, probably not recommending it at that spread. So this was the art of deal structuring that we used to have. Conversely, we could go the other side and write a higher loan. So if Wall Street's expecting 7.5%, and I just deliver a 7.25%, and I deliver a 0.25% higher coupon, I deliver a loan at 7.5%, it's my turn to play Yo Vinny the loan shark and say, I gave you more on your expected rate of return. I'm owed something. I'm owed a premium. So we could actually curtail a borrower's closing costs and give them a credit towards their settlement costs if they were short by $3,152, and they get the trade-off in the payment, about $53, $54 there. So this is what loan structure always used to look like when trying to explain the difference between a par rate, a discounted rate, and a premium rate. Things got a little more complicated when FHFA took over Fannie and Freddie in receivership in 2008 and have not given them back. So if we can roll to the next slide. You've no doubtedly heard in the news, probably earlier this year in May, there was a lot of chatter about LLPAs. So if you want to go back to my favorite website, Google, you can go down the rabbit hole, loan level price adjusters. The Treasury Department is very in tune with pricing risk, and they're actually skewing a little bit towards the first-time home buyer, go figure. And they have also priced themselves out of second homes and investor properties. They really don't want that clientele in their portfolio or credit pricing mix. So the deal has gotten far more complicated. It's tranched by property types, loan to values, credit scores, whether it's a cash out refinance, a rate and term refinance. There's a whole host, and actually the LLPA grid is 7 pages long. This is a truncated version, just to give you a little bit of a flavor for all the adjusters that lenders are pricing these days. My point is the deal structure has gotten very different. And with FHA having receivership of Fannie and Freddie and not likely to turn those over, your chances of getting a 0-point quote these days are far diminished. Expect to pay some fraction of a point in the deal these days. It's just kind of the new norm. How to mitigate that gets into, again, the loan officer and measuring the income and what bucket can we fit you into that is best going to utilize the resources that you have and obtain the goal. So what used to be fairly simple in deal structuring is now a little more complex. There's a little more art to it. But if you get to advise clients, advise them to go look at loan level price adjusters, there's a myriad of grids, and we really have to be very precise in the deal structure to get it right for the clients today. And I think we're getting near the end of our time, so I'm going to pass the mic over to Jackie. Are you covering appraisal bias?
You got it. Thanks, Bill.
Awesome.
Okay, so I'm going to wrap it up. Okay, Ann, do you have any questions coming in? No. Okay.
Yep. Just noting that this is the last section of our presentation. Obviously, we're a little tight on time, but we may go over a couple of minutes just to ensure that we allow time for any questions that come in.
Okay, and I'll make this quick. Is that some of the hot topics? One of the biggest hot topics out there now when it comes to mortgage lending is appraisals, and I'm pretty sure you have heard folks have said that if they have to remove pictures or stuff from their homes and they find out if the prior appraisal, I'm just throwing the example out there, was $500,000, they move any kind of pictures or show anything personal about it, then the appraisal of their value of their house goes up. So there is, I would say the majority of appraisals out there are doing the right thing. They're doing exactly what they're supposed to do, but of course there's going to be some bad apples. So there are those persons who are, if you find yourself in a situation where your property is appraised, house you want to buy or sell or whatever, and the appraisal is coming in kind of strange, understand that it does happen out there, that unfortunately there's bias. Things like redlining and steering still exist, but Greg B said that you had to be able to be provided a copy of appraisal, free. But again, there is bias out there, and if you want to go to the next slide, okay. Right now, this is some of the sources out there I'm going to point you to if you want to find out more about what's going on. What is the government doing about examples or accusations of bias? The one in the middle where it says a project to tackle appraisal bias continues with November 1st hearing. There is a streaming video of that hearing from November 1st that was held by Fannie and Freddie, and it was actually the third one that they had this year where they're actually taking those accusations of appraisal bias very seriously. So they're stepping in, and they're seeing in certain situations where certain language or certain terms were put in appraisals where persons who might have had their loans approved, unfortunately had them not approved because of certain language in there. So if you want to find out more what's going on and what the regulators are doing regarding appraisal bias or the accusations of that, then I'm going to point you to some of these resources right here. The next page talks about automated valuation models, and that's getting away from, appraisals are usually in person. You have a person that goes out, looks at the property, does the report, and then comes back with a valuation. Now we have automated valuations where a lot of information from different sources, databases, and things being brought together, and they're coming up with valuations of property. Now, we know that any model that's built is built by humans, so unfortunately, there's going to be some bias built into that, hopefully as much as possible. That's not to say that computer models and algorithms are not being used now by mortgage loan originators to come up with a value, or using for valuations, that sort of thing. But now we have to think about, okay, if it's being automated, values are being used and biases being built in, how does that affect borrowers? What is the effect on that? Or is there going to be overvaluation on certain homes and undervaluation on certain homes? Because again, this all goes to whether or not you can get a home and what the price is. So this is something that's very important. It's out there. And for all the lawyers, if this is something that you have interest in, or maybe you're working with clients and they're coming back and telling you this is an issue that they've encountered, then some of these resources that is on this slide and the previous slide, I'm going to point you to for more information. Thanks.
All right. Thank you all. And thank you to those who submitted questions. We are at the 90-minute mark, but we can hold on for a minute or so. If anyone has any burning questions for our panelists, please submit them now. I'd also just like to share the contact information for our three panelists. If you have follow-up questions, would like to reach out to them, have any questions that you didn't feel comfortable asking on during today's program and would like to ask our speakers individually, feel free to do so after we conclude the program. And just as we wait a minute or so for any last minute questions to come in, I have a question for all three of you. What is your recommendation in terms of how long a borrower should wait before reaching out and finding a loan officer and starting that path in the application and mortgage process?
I would say don't wait. The time frame for that is zero. It costs nothing to sit down with a loan officer and get good counsel and advice. Even if you are planning to look in a year, great. Sit down, have the conversation now. Get the rapport established, get some good advice so you know what you're attacking. Are you working on savings? Are you working on debt curtailment? Do you need more time on your job before income becomes stable? No time like the present. It's never too early.
Exactly. I'd say the same thing. As soon as you identify that purchasing a home is something you want to do, for all the things that we just went over and kept telling you, and some of our answers may sound vague because we say it depends. It truly does depend on the individual. So talking to a loan officer, well ahead of time. They're going to tell you one of two things. Either there's some things that you can work on, or everything's good and keep doing things as you're doing them. So make sure you find someone who will be transparent with you, and you be transparent back to them, and you feel comfortable communicating with each other.
We do. I want to get that also. It is, do it now. If this is something you want to do, like I said, you can hear a lot of things about the housing market. Again, if this is something you want to do it now. And there are persons in their system, and just you being on this call today shows that you are interested in this. All the information that we provided to you is good information that you can take, because now you're armed with a lot of information. So when you sit down with someone and you're talking about the loan application process, you already know a lot that's going to happen. So you know what to bring with you and to be prepared and help that person who's going to be your counsel, who's going to be your guide, to help you get to the home that you want. So don't wait, do it now.
Any tips on finding a reputable loan officer? Where do you turn? How do you start?
I would say two. First, start with your community and your sphere of influence. Talk to friends, family, realtors, if you know any, real estate attorneys. Great places to back vet the good, the bad from the ugly. And the other one is go to NMLS.org. NMLS is the National Licensing, and if there are any disciplinary actions or complaints against the loan officer, they are there. They are public record.
Great. I just put that in the chat as well.
Excellent.
All right. Well, I think that sums it up, and that concludes our program today. Thank you all so much. Jackie, Tiffany, Bill, thank you for sharing your knowledge and expertise on this important topic. And thank you to all of our viewers who joined today.
Hey, thank you. Appreciate it, guys.
Thank you so much.
Thanks. Take care.